I want to show you something that Bank of America's data is confirming right now, and it is one of the most counterintuitive things happening in financial markets. $2 trillion has been wiped from U.S. stock markets. Billions have been wiped from crypto. The charts are red. The headlines are alarming. Social media is flooded with people sharing screenshots of their losses and asking whether they should get out. And while all of that is happening, while retail investors are selling at a pace that the data describes as record-breaking, institutional capital is flowing in the opposite direction. Bank of America's internal data shows institutions leading inflows by the billions across systematic ETFs and risk assets, not slowing down, not waiting for clarity, buying now at these prices. Here's the question I want you to sit with for the next 8 minutes. If the institutions that have spent decades studying markets, that have entire teams analyzing these assets 24/7, that have seen every macro cycle, every geopolitical shock, every moment of maximum fear, if those institutions are buying right now while retail is selling, what do they know that the retail seller does not? That question has a clear answer, and today we are going to walk through it precisely. Welcome to the Calm Analyst. Let me lay out the data clearly, because the narrative in the market right now is backwards, and I think it is important to name that directly. The conventional wisdom when markets drop sharply is that institutions are selling, that the big players are exiting and retail is left holding the bag. That narrative is intuitive, it is emotionally satisfying, and in this particular moment, it is wrong. Bank of America data is showing the opposite. When the $2 trillion wiped from the U.S. stock market, institutions were leading inflows. When crypto markets fell, ETF flows showed institutional capital absorbing the available supply. The large players with the deepest market analysis capabilities are not running from these prices. They are accumulating them. Why? Because institutions operate on a fundamentally different time horizon than the retail investor who is watching a red chart at 11 p.m. and deciding whether to sell. Institutions are not managing the anxiety of watching a position decline 20%. They are managing the mathematics of what an asset is worth relative to its long-term fundamental value. And at current prices, across technology stocks and crypto alike, that mathematics is pointing to discount, not danger. Now, does this mean markets cannot go lower from here? No. Institutions understand that possibility explicitly, but their response to that possibility is not to sell. It is to keep buying, because they have enough conviction in the long-term trajectory that the difference between buying at the current price and buying slightly lower is less important than the difference between being positioned and not being positioned when the recovery comes. That is the institutional framework. And the retail investor who understands it stops making the most expensive mistake in investing, buying at highs out of excitement and selling at lows out of fear. Let me add the political dimension of this story, because I think it is one of the most significant structural tailwinds for crypto that has ever existed, and the market is not pricing it fully. Eric Trump stated publicly on live television that cryptocurrency is going to replace traditional finance, and that it is happening faster than the growth of the internet in the 1990s. Now, Eric Trump is not a financial analyst, and his statement should be weighed accordingly. But the significance is not the specific claim. The significance is who is saying it, where they are saying it, and what administration is actively working to make it policy. The current White House is the most explicitly pro-crypto administration in American history. The president campaigned on protecting self-custody rights for 50 million crypto holders. The CFTC and SEC have jointly issued digital commodity guidelines